Well, stocks bouncing back in a big way after last week's sell-off. This as markets look ahead to the Fed's rate decision on Wednesday. Let's bring in our market gurus, Francis Stacy and David Nicholas. Francis, asking you what exactly is causing this rally, I think of that phrase, catching a falling knife. I'm just wondering how many investors are doing that today.
Yes, certainly. I mean, you had a technical setup in the S&P 500 because you had three lower highs in a row, which is a kind of a technical breakdown. You have this higher for longer rate narrative coming out of the Fed. You don't yet have any major credit events that are popping up, although you see slowing demand in the background that, are going to force the Fed's hand. So they're going to keep their hawkish rhetoric because you have a bit of a reacceleration in inflation. And so basically, the markets for the short term are oversold, but we will continue to see revaluations as the demand continues to wane in the economy.
And David, I don't want to rain on anybody's parade, but on the other hand, inflation has not yet gone away. And we just had another sign of it. The Wall Street Journal had a piece on worker productivity, which is pretty far down right now. And when productivity is down, that means there are more inflationary pressures. So it's going to be something that the Fed has got to consider this week.
Yeah, it is. And I think the market has been bullish, leaning towards this Fed meeting this week in hopes that the Fed will pause rates. But I think you're right, David. Well, what if inflation continues to stick around? I think we could be in this kind of this sandwich between, long-term rates maybe continuing to go up, but the Fed doesn't really have an answer for what's going to happen on the inflation front. So I think, again, you're going to see rates that are going to continue to stay, I think, well into 2024 without seeing rate cuts. So if we don't get rate cuts in 2024, I think the party for the market is not going to be the same going into next year. So I think there is this optimism right now that if inflation, we see some declines in inflation, that helps. Obviously, we see energy coming down a little bit in price. That helps overall with inflation. But some of these areas like wages that are just so sticky, it's going to be a very tough time for the Fed to really hit, which I think it's going to be tough for them to lower it right away.
And Francis, while there was good economic news in terms of growth, the GDP number last week was much larger than expected. It turns out that big ticket items, stuff that sticks around for washing machines, motorcycles, what else do they include? Air conditioners. Big ticket items are not selling that well. A lot of this is more frivolous stuff that people buy in their credit cards and don't really worry about.
Yeah, Invisalign and Botox. It's just the things that people can do without. And you're starting to see that wane in demand, which is actually perfectly normal for where we are in the business cycle. The business cycle mechanics, even though there were tons of sort of anomalies around COVID and the pandemic and the amount of money that was put in the system, but the business cycle mechanics of tightening haven't changed. And what happens is the Fed removes money from the system, but you have that record amount of debt from the new money that was created and people putting things on credit cards. And they remove money out of the system until that debt is not easily serviced, and then they pivot, and that's what's going to occur. So these are very early signs, but these sort of credit event / recessions that are mechanical happen, slowly. You start to see cracks, you kind of doubt it, and then happen all at once. So we are just starting to see those early signs. And as market participants, of course, we try to, trade where the puck is going, not where it is today.
Right.
So we will see a little bit of a uptick in inflation because those things are all lagging, those price increases that we saw earlier. But at the end of the day, the demand is waning and the big ticket items are early signs.
Yeah. And David, the other thing is the Fed has this notion that the only way to really cure inflation is by having an economic slowdown. The GDP number showed anything but that. I'm just wondering again, is there still a possibility that we may see a 25 basis point raise of rates this week?
I think that's almost all but off the table. I think for this week, I think the market would not respond to that. I think if you look at what the Fed funds futures look like. But I do think the Fed is going to be watching what is this war and what is the impact on consumers. I think we're seeing a mindset shift where we're seeing a more cautious consumer. Right? If you just look at imports are down big, the lowest level since 2021. Imports from China are down 25%. China's now third behind Canada and Mexico. So I think that is showing that there is a slowing demand for goods. We're seeing services pick up, but this is something I think the Feds will watch. And if we continue to see the slowing in demand, I think it leaves the Fed in a situation where they may have to either lower next year, even though the market is hoping for sooner than that. But I think we'll see it.
All right, David and Francis, thank you both. Appreciate it.